Gold is holding near the $4,000 mark after the US Federal Reserve made a widely expected rate cut but gave little hint of what comes next. The Fed lowered its benchmark rate to between 3.75 and 4%, saying the US economy is still growing at a moderate pace and inflation remains high. Now, the move steadied markets but left investors unsure about December's outlook. Here in Canada, the Bank of Canada also cut rates to 2.25%, while copper held firm on supply concerns and oil eased on talk of more OPEC plus output. Now, Rebecca Teltscher is a portfolio manager at Newhaven Asset Management. We're going to take a look and see what's been happening on the markets. Rebecca, thanks indeed for talking to us.
Thanks for having me.
Well, look, it's been a very interesting week, right? Rate cuts on both sides, the US and Canada. You had Fed Chairman Jerome Powell signaling that there's simply no guarantee of another rate cut in December. That's a big factor when we determine the market mood or lack of certainty at the moment. What do you think?
Yeah, I mean, listen, at the end of the day, I don't know what's causing this market momentum. It seems like a little bit of a euphoria. Economic data was weak prior to the government shutdown, and now that the government shutdown is still ongoing, we're kind of blind with regards to economic data in the U.S. Markets keep coming in. Markets are still hot, and inflation numbers are, again, like you just mentioned, are at risk of going higher with ongoing tariffs, trade concerns between the U.S. and China. I think the market is pricing in that's going to be, alleviated or a deal will be made. But again, it's still very uncertain from now. But the market, I think the market is really just banking in more rate cuts. And as we saw yesterday, Jerome Powell said that, another rate cut in December is not certain. It's very difficult to, if I was the central bank, I think it's very difficult to make a decision on whether or not to cut rates when you're not getting the economic data that's available, based on the government shutdown. So, we're really going in blind here as investors and, and for the central banks.
Yeah. All right. So I want to try and understand where gold fits into all of this, right? So gold had an interesting week. We saw that dive below $4,000 on Monday, and it's been hovering thereabout or perhaps just below that mark for a while. Look, what's influencing bullion this week?
Yeah, I think, gold is showing some signs of weakness because everyone is factoring in that there's going to be a trade deal solidified between the US and China. And then that's causing, gold, who generally is like this flight to safety whenever you feel that there's, geopolitical tensions or risks to the US dollar or risks to inflation, like that's where gold ends up being a safe haven. And I think when there was talk about, China and the US working out a deal, gold came down and at one point I think it was off 20% from its high, or at least not so much for gold prices, but at least for the gold producers that we own in our Canadian portfolio. And so there's a little bit of an opportunity there to add a little bit. I mean, gold stocks have still, really outperformed over the year, not just this year, but last year as well. But there is a little bit of an opportunity to dip in at a small amount, because that 20% drop is really based on something that's still very uncertain right now.
Yeah, that's an interesting way to look at it. We've seen a mixed performance across the mining space this week. Gold producers rising modestly while diversified miners lagged, Rebecca. What's driving that divergence? I mean, are investors underpricing the upside in quality mining names here?
I think what's really happening is that there's a divergence between, it's two different stories. I think investors flock to gold, as we said, for when they feel that there's economic uncertainty, geopolitical uncertainty. And the other, diversified miners, whether it's copper or iron ore, that's more linked to economic growth. So two completely different sides. So if you think that the economy is going to be great and that there's no risk to a recession and that everything is fine, you're going to, that's when diversified miners, specifically copper and iron ore that's linked to economic growth, they should outperform. If you think that the economy is at risk, that, trade tensions remain high, then you're going to flock towards gold. And so I think that's the two stories. And depending on the day, depending on what Trump says, depending on what we're seeing in the economy, it'll fluctuate between what's, the mining stock of choice for the week.
Okay, so as we wrap up, let me stretch that out a little bit, right? For investors trying to position in this cross current of rate cuts, inflation risk, and commodity volatility, what's the smarter trade right now? Difficult question, but you got to put it out there. Staying defensive in gold or leaning into the broader mining sector recovery story?
I'm probably the worst person to ask for this because we are defensive on a regular day, let alone, on a day like today, on a market like today. So on a regular day, we always, cater towards defensive stocks, like utilities and telcos, those stable stocks that produce dividends, that produce, earning reliability, predictable cash flow. In a market like today, where we think markets are very speculative, valuations are very high and stretched, we're leaning more towards the defensive area. Now it's hard because gold has had a really good run, but if you're looking between the two, I would believe on a long-term basis, let's stick to the defensive. Let's stick to what we know. I do think we are going through a period of economic weakness, so I would be hesitant on investing in any space that's more cyclical based, because I think especially in Canada, we are seeing risks, with regards to employment and real estate and, and GDP growth. Like, I think we're seeing signs of a lot of weakness ahead. And so I would not be looking at any sectors that are linked to economic growth, because I do think those will be at risk and at risk of at least a multiple contraction from here.
All right. Okay. Fair enough. That's interesting. Well, Rebecca Teltscher, Portfolio Manager at Newhaven Asset Management. It's always a pleasure. Thanks for chatting to us.
Thank you so much.